Okay, so today, Friday, September the 28th, my name is John Richardson. I'm sitting here in Toronto, Canada, and I'm continuing my series of interviews with people on the issue of renouncing U.S. citizenship, which has become a much more timely topic, certainly over the last few years, and the sort of escalation of legislation and et cetera has certainly I think made it entirely possible that a lot more people will be renouncing, or at least considering renouncing U.S. citizenship than perhaps have in the last few years. And I'm having a series of people to discuss this with. And here we have today Olivier Wagner, who's been done shows with me before. I think specifically in December we did 2 on tax residency, and he participated with Solomon Yu in our discussion of the possibility of ending U.S. citizenship-based taxation. And here today he is joining me to give his perspectives on renouncing U.S. citizenship. Good idea, bad idea, I don't know, or maybe it depends on you sort of thing. Olivier, for those who don't know him, runs 1040 Abroad at 1040abroad.com. He's basically an international CPA who focuses on U.S. expat tax issues, which, to put in people talk, he knows what the forms mean and how to fill them out. So, thank you for joining me today, Olivier.
Thank you for having me.
So, Olivier, are you getting people talking about renouncing U.S. citizenship?
Yeah, definitely. As you said, increasing over the years. It used to be that I would just have one person, then I had your clients, and now even people I wouldn't expect, regular expats, start to talk about that. There was I think the transition tax when it comes to foreign corporations, CFCs, the taxation of undistributed untaxed income.
Oh my God, I mean, that's just a total horror story. So basically, what that is for people who have been running small business corporations, you know, like normal residents of other countries. As part of tax reform, it included this crazy, I wouldn't even call it tax because there's no realization event, just this sort of confiscation of income that was previously not taxed under U.S. tax law.
Yeah, it's realized at the corporate level, but not at the individual level. There's provisions called Subpart F income to include it in the taxpayer's income.
Subpart F, it sounds buried down where you can't even see it. Is that correct? I mean, have you ever known a normal person who's known anything about Subpart F?
No, it's quite an interesting topic.
Interesting?
Yes, very interesting.
Yeah, well, so what Subpart F is, in a general sense, is it is attributing the income of the corporation, which is a foreign corporation the United States can't tax, saying, yeah, my God, you know, if we can't tax that income, you know what, by God, we're going to pretend that you received that income and we're going to tax you. That's how it works, right?
Yeah, in the CFC rules came into place in 1962, and until then, people could create a foreign corporation, accrue income there, and then sell the shares of that corporation, and then not only defer the income, but have it taxed at the long-term capital gains rate. And so all of these rules came into stopping this practice. And
this was 1962.
Mm-hmm.
Do you know Templeton Mutual Funds?
I do.
So John Templeton, who was a pioneer in offshore mutual
moved
funds,
to Canada,
so to
renounced U.S. citizenship.
Yeah, well, I mean, he renounced U.S. citizenship in 1964.
Exactly.
I find it hard to believe that wasn't the reason. Never got a chance to ask him, although I haven't. I used to go and hear him speak when he was alive, but I'm sure that was the reason. So yeah, I mean, it's sort of like all Americans abroad are now experiencing what Sir John Templeton experienced that led him to renounce U.S. citizenship.
And I think we know someone who renounced during the last days of 2017 to avoid the transition tax.
We do?
Yes, we do. Not important.
Okay. I mean, I think that may be very possible. I mean, the transition tax is really, there's sort of a culture of corporations in different countries. And in Canada, these small business corporations really are substitutes for private pension plans. So really what this is about is the outright confiscation of, private pension plans in Canada.
Yes, and what you're touching upon, it's not technically a pension plan, but it's a tax privileged scheme plan that exists under Canadian law, and that is there to help Canadian residents, favorize some sort of savings, having your corporation, there's TFSA, RESPs, and all of these provisions that the Canadian government has to encourage some sort of savings disappear when you're a US citizen, because you also have to file in the US, and the US doesn't grant the same tax exempt status. So
Well, to
that's-
put it another way, so people subject to the Internal Revenue Code outside the United States, so these citizens, green card holders, what have you, are subject to all the provisions of the Internal Revenue Code, which severely restrict the ability to participate in normal financial planning in Canada. So, we've got the small business corporation problem, very dangerous, very dangerous. What are some other ones that you can think of?
TFSA, RESPs.
What about the personal residence, principal residence?
Yes, definitely.
Yeah, I mean that. I think that's probably one that affects the largest number of people because, as you know, in Canada, the principal sale of capital gain on principal residence is not taxable, and in the U.S. it is. Subject to a relatively
And the amounts
small.
are much greater than your typical TFSA.
Yeah, so I mean that's a big problem that affects everyday people. The
Yeah.
registered plans, when we say registered, we mean in Canada.
Yeah.
They of course are not. They don't have any special status under the Internal Revenue Code. And but for the provisions in the Canada-U.S. tax treaty that gives special privileges to pensions.
Yes.
I mean, even, say a University of Toronto professor who had a pension at the University of Toronto would not even be able to accumulate that, tax-free. So, this is a very, very serious problem. I mean, I've heard it said, and I think that this is correct, that tax-compliant Americans in Canada basically get the worst of both systems.
Yeah.
Mutual funds?
PFIC, yes.
Do you really believe they're PFICs, or do you believe that so many people have decided they're PFICs, so that's now the expectation? It took me a long time. I don't think I've ever really accepted the idea that those are PFICs personally, but
I came to the conclusion that the laws of Ontario before 2004 didn't provide true limited liability, and therefore they were not corporations, therefore they were not PFICs. And once the mutual fund is created, it maintains its status even after the laws were changed to provide true limited liability to investors.
So, yeah, now let's unpack that a little bit, because I think that might be of interest to some people watching this. So we're talking about a PFIC, passive foreign investment corporation. So it's got to be a corporation under U.S. law, and there are entity classification rules. In other words, you don't look at what it's called, you look sort of at what it is. And one of the characteristics, as I understand it, for something to qualify as a corporation would be that there has to be limited liability on the
Yes,
part of the
exactly.
shareholders, right? So if you had a mutual fund that was either a trust or one where there was
Yes.
unlimited liability, then by definition that would not be a corporation and therefore could not be a passive foreign investment corporation. That's the logic, right?
Yes. Actually, PFIC stands for company, but once you go into the Interrevenue Code, it defines it as corporation. But the acronym.
But that's the theory, right?
Yeah, the acronym uses the word company, not that it really matters.
Yeah. So
And-
the issue being that you want the unlimited liability. Now, last week I was looking at something else. I'd be interested in your thoughts on that. The check the box rules appear to operate in such a way that if there's not limited liability, that you can designate it as not being a corporation, right? Is
That's
that
the thing, but the investment company would have to make that designation, and the taxpayer probably wouldn't know whether the designation was made or not. And chances are that the investment company wouldn't have had their U.S. citizen clients' best interest in mind to the extent of.
And now, how could that be that they wouldn't have the U.S. citizen clients? Shouldn't they be paramount?
Their
No, I'm only kidding.
Well,
They're just
targeting
trying to survive under Canadian law. They've got their own set of regulatory problems.
exactly. They're marketing a financial product in Canada to Canadian residents. They don't.
They're trying to make them attractive to residents in Canada in the Canadian regulatory environment and tax laws,
Yeah.
correct?
I think there's a few who actually provide QEF statements such that if the taxpayer is filing on a timely basis, they can fall under a regime making the QEF election that is less.
They can avoid the interest deferral charge, in
Yeah.
other words, yeah, okay. All right, so, I mean, I think that we've established beyond a shadow of a doubt that it's, from a tax and regulatory point of view, it's extremely difficult to exist as a U.S. citizen outside the United States. Now, I'd be curious, you are in an unusual situation in that, you do people's tax returns and you actually see their financial situations in a much more intimate way than probably anybody else. What is your sense of this? You would agree that the situation is getting worse?
Yes, it's not getting better, definitely.
It's definitely, okay, there's no trend toward it, unless, of course, we get this territorial taxation, okay, which wouldn't remedy it completely, but we move in the right direction.
And that's the thing. Citizenship-based taxation has been the law for 2 centuries or so, but
150 years. Don't exaggerate.
All right.
Olivier.
Well,
Well, it's
50.
only 150 years.
I wasn't there when it started,
You
so
weren't?
no, I'm a little younger than that.
I wasn't either.
Okay, cool. Point is, they didn't really have an enforcement mechanism to enforce it. And even though in theory we existed in a citizenship-based taxation regime, in practice people didn't file and nothing happened. They got back into compliance when they contemplated moving back to the States. And the piece that really got people to get into compliance was FATCA and banks forwarding information to the IRS.
You think it was FAC, or do you think it was what I've always called the FBAR fundraiser, the 2010-2011 marketing of the disclosure programs?
From my
both.
counsel, I am more from FATCA.
Okay. All right. Are you finding, FATCA has definitely been a factor, but what I'm actually seeing is that the CRS, the Common Reporting Standard,